Let's get right into it. Growth in the industrial sector, it usually moves at a completely glacial pace. But today, we're unpacking a massive, incredibly rapid transformation of a company called TIC Solutions. We're looking at a fascinating explainer of a business that moved from a reliable, legacy engineering firm to a true $2 billion infrastructure powerhouse. And they did it practically overnight by leveraging an incredibly aggressive M&A strategy and capitalizing on some absolutely unstoppable global megatrends. They've positioned themselves right at the center of how we build, inspect, and maintain the physical world. Here's exactly how we're breaking it down today. First, the TIC Solutions evolution. Second, the NV5 acquisition effect. Third, core segments and operations. Fourth, 2025 and 2026 financials. Fifth, market megatrends and tailwinds. And finally, the 3/1885 future framework. Section 1. The TIC Solutions evolution. Let's start with the foundation. To really grasp where this company is heading, you have to appreciate the steady, decades-long build that got them here. Founded way back in 1965 as Hansen Materials Engineering, they spent a half-century steadily growing, right? They hit about $60 million in combined revenue by 1997. It was a solid, highly respectable business. But then, look at the extreme compression of events over just the last couple of years. In 2024, they completed a public listing. In 2025, they completely rebranded to TIC Solutions and acquired NV5. Then, early in 2026, a new CEO, Ben Herod, takes the reins. They literally went from being a methodical, slow grower to operating at absolute warp speed. Section 2. The NV5 acquisition effect. Let's dive into the main catalyst behind this warp speed growth. The year-over-year contrast we're seeing is just undeniable. We are talking about a massive 108% revenue leap for the first quarter. They jumped from $234.2 million in Q1 2025 to exactly $488 million in Q1 2026. Now, obviously, this isn't organic growth. This is the direct result of absorbing NV5 back in August of 25. By combining these two entities, they instantly bought scale. And in the world of large-scale infrastructure and compliance contracting, scale is literally everything. It lets you bid on much bigger projects, cross-sell to your larger clients, and weather regional economic dips. But acquiring revenue is really only half the battle. Behind that massive jump, management is hyper-focused on integration. They are actively targeting $25 million in annualized cost synergies by mid-2027. And they actually expect to realize about half of those savings in 2026 alone. So this tells us they aren't just bolting NV5 onto the side and hoping for the best. They have a dedicated integration team in there actively squeezing out operational redundancies. Section 3. Core segments and operations. Let's look at how they actually make their money. Breaking down their 2025 combined revenue, the anchor of their business, making up 52% of the pie, is their legacy inspection and mitigation segment. This is highly resilient, non-discretionary work. Think regulatory compliance testing that companies are legally mandated to perform no matter what the broader economy is doing. Then you have consulting engineering, making up 34%, and a smaller but incredibly exciting geospatial segment at 14%. Let's make this a bit more tangible. Out in the field, inspection and mitigation is all about asset integrity. We're talking about the non-destructive testing of pipelines, chemical plants, and wind turbines to guarantee they don't fail. Meanwhile, consulting engineering supports the entire life cycle of a structure. They are involved from the very first blueprint all the way to the final commissioning of major public infrastructure and commercial buildings. And the beauty of this is that it's highly sticky work. Once you're engineered into a massive project, you tend to stay there for the life of the asset. And that brings us to their fastest-growing, deeply tech-forward segment, geospatial analytics. This isn't just flying drones around a worksite. This is capturing massive amounts of physical data and running it through advanced analytics. They've actually just started rolling out a new AI-enabled platform called GeoAgent to their clients. This is a huge deal because it takes them out of traditional industrial services and squarely into the realm of highly scalable, high-margin technology solutions. Section 4. 2025 and 2026 financials. Let's see how this operational scale translates to the bottom line. Checking their vital signs, they hit roughly $2.1 billion in revenue for 2025, bringing in an adjusted EBITDA of $312 million. Looking ahead to 2026, they're guiding for steady top-line growth pushing up to between $2.15 and $2.25 billion, while expanding that adjusted EBITDA up to a potential $355 million. Now, I should point out they did report GAAP net losses recently. specifically a $41.5 million net loss in Q1 2026. But honestly, this is incredibly common for companies digesting massive debt-fueled acquisitions, mostly due to heavy interest expenses and amortization. The underlying operating cash flow, represented by that growing EBITDA, remains super robust. That's even after absorbing an $8 million compensation alignment headwind from the NV5 integration. And if you want an incredibly strong indicator of their forward momentum, look no further than their backlog. It currently sits at a staggering $1.07 billion. That's roughly a 10% year-over-year growth. So why does this matter to us? Because in the contracting and engineering space, backlog is your ultimate crystal ball. It gives you deep visibility into future revenue and proves that market demand for their combined services is genuinely accelerating.
Section 5. Market Megatrends and Tailwinds. Remember, numbers never exist in a vacuum.
A company is really only as strong as the currents it's swimming in. And right now, TIC Solutions is in a fascinating tug-of-war. On the strength side, they are absolutely surfing a massive wave in data center construction. Their data center revenue nearly doubled in 2025 to around $70 million, and management sees a very clear path to $100 million. But on the risk side, their legacy inspection business faced some very real headwinds down in the Gulf Coast. Slower chemical activity, delays in LNG construction, and tight pricing competition really squeezed their margins down there, forcing them to restructure their regional approach. It's a great reminder that even highly diversified companies always have exposed flanks. But despite those localized risks, management firmly believes they're insulated by four major, non-discretionary megatrends. Aging infrastructure requires constant testing. Surging energy demand requires widespread grid modernization. AI and cloud computing demand relentless data center builds. And the digitization of the physical world? Well, that requires exactly the kind of geospatial mapping TIC provides. These aren't just fads, folks. These are structural, multi-decade shifts in capital allocation that play directly into TIC's strengths. Section 6, the 31885 Future Framework. Let's see how all this builds into their grand strategy. At their inaugural Investor Day in New York City, incoming CEO Ben Hirad stepped up to the microphone and set a very confident tone. He made it crystal clear. The goal now is building a scaled, differentiated provider of mission-critical services to create long-term value for all stakeholders. This new era is all about leveraging the massive combined scale of legacy Akron and NV5 to become an absolutely irreplaceable partner for their clients. And to get there, he laid down what the company is calling the 31885 framework. By the year 2029, they intend to hit 3 precise operational targets, crossing the $3 billion revenue threshold, expanding profitability to an 18% adjusted EBITDA margin, and achieving a highly efficient 85% free cash flow conversion rate. They're planning to pull this off through organic cross-selling, finalizing those NV5 cost synergies, and pursuing highly disciplined, targeted acquisitions using their freshly authorized $200 million share repurchase and capital allocation program. Which leaves us with the ultimate question. The strategy? It's undeniably brilliant on paper. The megatrends are real, and that billion-dollar backlog is growing. But merging two massive corporate cultures while simultaneously optimizing costs in a high-interest rate environment is incredibly difficult. As they transition from a phase of heavy acquisition to a phase of relentless, disciplined execution, can they actually pull it off? That is the multi-billion-dollar question the entire market will be watching very, very closely.